Welcome back, traders. We're here with Dave Moenning of stateofthemarkets.com. Dave, great to have you with us. How you doing this morning?
I'm doing great. Thanks for having me.
Dennis, you want to give a shout out to Dave there?
Dave, how you doing here? We're sorry, but we had a little bit of technical difficulties here, so we do apologize. The audio quality is a little bit less here, but we do have Dave on the phone here now. And Dave, so how is it going this morning? Can Dave hear me?
Okay.
So, Dave, can you just give a little bit of background about yourself here? We know you run the website State of the Markets, it's plural, www.stateofthemarkets.com. Can you just give a little background on yourself?
Sure. I'm a professional money manager. Have been in the money management business since 1987. You know, timing is everything. We started stateofthemarkets.com in, or what is now State of the Markets, in like 2003, 2004. Hooked up with the guys at Benzinga, great group, just recently, and trying to bring professionals' point of view in terms of money management to the public, and that's the goal. We post an awful lot of research and things like that on the site, so check it out if you want.
So you're like a macro guy. You kind of look at the overall macros and then try. Are you then playing, the overall? Like, are you buying like the indexes, or are you buying individual stocks here as well, or how's your investment approach work?
Yeah, I wouldn't call us macro.
Okay.
We have more kind of in between. We're not really quant 100%, not really subjective 100%. We run stock portfolios. We run trading programs, market timing programs. And basically what we're doing is bringing the stuff we do for clients to the general public via the website. Our overriding goal is to be, mostly in the market when the bulls are running, and then get the heck out of the way when the bears show up.
So let's just go into what do you think here when we're looking at the market here today? What do you think, because we've been on this crazy bull run here. I mean, like, we've been talking about it on the show. Every time we pull back here, we seem to find more buyers here. What can derail this rally, like, especially with respect to the U.S. markets here, because the U.S. markets have just been on fire. It seems like every time, we get concerns with, whether that was over the budget or whether that was over the fiscal cliff or whatever it has been in the last year, the concerns just seem to, people just keep coming and buying the market no matter what. Do you see anything that can really derail this rally?
Not so much at the moment. You've got, I think if you haven't been in this business since before 2000, I want to say welcome to a bull market, because we haven't seen something like this in quite some time.
Sure.
I've been around since 1980, so, I've seen markets that just run and run and run. But right now, I think the important thing to understand is markets trade on expectations. And what we've seen over the last several years is constant interruptions of the economic recovery. Bernanke wants to get us to escape speed so badly and avoid that deflationary spiral. But every year, starting in 2010, we've been interrupted by Europe, and then by Europe, and then by Greece again and again and again, and then Washington shooting itself in the foot, or shooting the economy in the foot. So the important thing to understand is markets trade on the expectations of the future. So the biggest concern going forward is basically the state of the economy. So we hit another speed bump late in the summer, just like we have for the last several years, and growth slowed down a bit. But based on the market actions, traders are basically expecting things to get better in the next 6 months. So, I mean, if you look at it from a big picture point of view, 30,000 feet, earnings are at record highs, inflation is low, interest rates are low, and the economy is likely, keyword, to improve. So it's a pretty darn good environment for the stock market.
And,
but, go ahead.
No, we could talk about things that are going on in the United States, but there seems to be pretty good reactions in the market when we get news on China. How do you see a slowdown in the Chinese economy, the spillover effect into our markets?
Okay, yeah, China's obviously been a big concern for the global macro crowd. One of the, which by the way has really gotten things really wrong this year, just all year. One of the themes coming into 2013 was the idea that China's economy was going to hit a hard landing and slow down more than the 7.5% that they were projecting. But that really hasn't been the story. I think it's again, this is not a new story. The China slowdown, that is. So growth has actually. If you look at the flash PMI, which is done by HSBC, that came in better than expected this week. So that, I think, is a positive kind of surprise to the upside. But you've also got the issues of, the Chinese are trying to manufacture a bit of a slowdown so they don't have the bubble in real estate. Money market rates are rising. That we saw that bank write-downs in the first half of 2013 were triple what we saw last year. So while China remains something to watch from a macro basis, I don't think it's a real issue on the stage right now for traders. I have this saying that in the market, things don't matter until they do, and then they matter a lot. And I think that's what's going on in China. I think it's something you have to continue to watch, and I think it'll move the market a little. But right now, it's not a primary focal point in the U.S.
Now, just looking here, obviously we've kicked the can down the road here in the U.S. Do you think we're kind of fine until we get to, the next deadline here, or do you see this even as a concern anymore? Are they just going to continue to kick the can down the road? Or like I always joke with my one buddy there, when we talk about kicking the can down the road, like Peter Schiff was saying, well, you can't continue to kick the can down the road because eventually you're going to run out of road. I always say, well, they could just always print more money and build more roads. So, I mean, we've kicked the can down the road forever. I don't know if they're going to be able to continue to do that or not. Do you see this? Do you see us just continuing to do this indefinitely?
Well, I think it's always interesting. I'm a complete spaz about understanding why the markets do what they do, and I think we watch the action very closely relating to the news and to find the drivers of the market. So if you look back at the government shooting itself in the foot, or shooting the economy in the foot. Look back at 2011. We had basically a 19% correction over a very brief period of time based on fears of Europe, and then most importantly, the debt downgrade in the U.S. and the budget crisis. So we had that 19% correction. Then last year we had the bit with the sequester, and everybody's worried about that, and the world's going to come to an end where the economy's going to stop on a dime, and the market went down, I don't know, 6 or 7, 8%, something like that, but definitely less than it did in 2011. And now this time around, we had the world was going to come to an end. The idiots were going to blow up the economy, and traders just didn't bite too badly this time around. The market went down 3 or 4% from top to bottom. So while everybody knows about the deadline, we've got December 13th is the budget. We've got January 7th. We've got February 15th. Maybe I've got those backwards, but something in January, something in February.
Yeah.
I think the key is that no one on the planet expects even the Tea Party to go in and cause a debt downgrade, because that's just, catastrophic. So while they can bluster and, fight and scratch and call each other names, I don't think anybody's going to do anything really stupid, and that's really the key as far as the stock market is concerned. Again, all the market cares about is what the economy is going to look like going forward, and as long as the government doesn't blow it up, I think we'll be okay. So again, they didn't bite too badly this time around. I guess that would be the playbook going forward into December and January.
So you feel
we have not heard much about the European banks as of late, their financial stability, and that wreaked a lot of havoc in the market a year or so ago. Do you think the worst behind us for the European banks and as well as the European economies?
Yeah, two questions there. Number one, again, the markets don't really care that much. I'm sorry. What I meant to say was markets can handle just about anything eventually. So the Europe story, the Europe debt crisis is not new. All right, definitely not the problem that it was several years ago. The banks are, the second part of this, to answer your question, the banks are not in great shape, no question about it. And the economies are not doing well, but at the same time, they're not crashing and burning either. We're seeing actual improvement in the economic recovery right now. There is a recovery going on. We're not growing at any great shakes, but the Eurozone economy is doing, I think, better than the bearish global macro guys were expecting at the beginning of the year. So again, banks, unless there is a new crisis, my theory coming into 2013 was, unless there is a new crisis, you're not going to have a severe correction. And so far, there's been no new crisis, and there's been no severe correction. So you got to watch the banks. You always have to keep it, watch Europe out of the corner of your eye. But right now, it's not a focal point of the markets.
So with no potential real crisis, you think, coming, do you see the end of 2013 and obviously going into 2014, are you bullish going into those years?
Well, we don't make, I'm not a guy that uses a crystal ball, so I'll preface that. But, historically, Q4 has been a good time. You've got the seasonal patterns, and we look at cycles. We look at the 1-year cycle, the 4-year presidential cycle, and then the 10-year decennial cycle as well. And right now, that cycle composite suggests that, we'll probably have a year-end rally, but it's a little, this year is probably front-loaded. I mean, we're up, 23% so far this year in the S&P 500, more than that in the NASDAQ, more than that in small caps and mid caps. So, we've had a pretty good run. At the same time, performance anxiety is probably going to start kicking in here pretty badly. If you're a money manager and your bonus is on the line and you're not 100% invested, you're probably not going to, you're going to jump on. So I think I got to pay attention to that. So watch for performance anxiety to start moving this market higher. At the same time, understand that the hedge funds are grossly underperforming this year as a whole. I mean, obviously there's good managers in there, but as a group, they're underperforming. So people would like to see a pullback if possible, and it's probably to buy into.
Another thing that has spooked the markets and is kind of something that's going to be coming out eventually is a Fed taper. I mean, are they just going to keep prolonging this until they get signs that the economy is stronger, or do you think they're going to start to really actually start to taper in 2014? And how do you anticipate the markets reacting to the taper activity?
Well, first we had the taper tantrum back in May when Bernanke first started bringing it up. I think, he realized that he was going out, in January. I mean, his tenure was ending. So I think he did not want to leave on a completely bullish note. So I think they had to bring up the taper in May and June, and you saw what happened immediately. The 10-year yield almost doubled in a month and a half period of time. So that was the taper tantrum.
Right.
Since that time, again, my theory is that markets can handle just about anything. They just don't like surprises. So the taper is no longer going to be a surprise. In addition, the taper is not going to be an on-off switch. It's going to be a something that's very gradual. They'll start with 15 billion or something like that. The general consensus is that Yellen has been around for a very long time. She's not going to do anything radical like Larry Summers might have done. So I think we're definitely, the consensus right now is the taper will begin in March. And the reason that the taper has been put off is because of the idiocy in D.C. The Fed has been hell-bent to make sure that we do not go into a deflationary spiral a la, Japan from 1989 forward. And I think they've done a pretty good job at that. So with the government, with fiscal policy just being off the board right now and totally ineffectual, the Fed has to continue to do all it can to keep the economy out of that deflationary period. It's probably unnecessary at this point, but I think they have to err inside the caution right now. So with another budget battle looming, and anywhere from January through February into March, it's probably a safe bet that the Fed is going to stay on hold for a while until that's out of the way. And I think we've seen the market is not too terribly concerned. The big problem will be if there is a surprise.
We've got Dave Benzinga on here from stateofthemarkets.com. If there's any questions from our viewers out there in the chat room on any particular issue, we can throw it at Dave. That's a close question of Dave.
Well, actually, let's just move away from the economy. I'd just like to find out a little bit more about your website there, Dave. You've got the stateofthemarkets.com. Tell us a little bit about your website and tell us a little bit more about your investing strategies.
Yeah, thanks, Dennis. Our investing strategies are, basically professional, and I don't mean that. I don't know how I mean that. I've been managing I've been managing other people's money, or OPM as it's called, since 1987. I've been running my own firm since 1989. One of the reasons I got into this business was I felt that the newsletter business was kind of a slimy, slippery place where people were guaranteed, 1,000% returns in the next 15 minutes, and that's kind of bunk. And I think it misleads people to a great degree. So I wanted to bring a professional money management point of view to the newsletter space. As a money manager, we did really well in 2000 through 2002 when the tech bubble burst. And, that really wasn't a hard bear market to miss. Unlike 2008, which was very difficult to understand, all you had to do in 2000 was take your foot off the gas. Get out of growth, get out of tech. So we want to bring, actionable portfolios, and we are primarily portfolio managers, not necessarily, the fast money traders. We're definitely not the fast money. So if you're looking for that, please don't come to our site. But we do want to provide, kind of a one-stop shop for investors. Everything you need to know about the stock market that I need to know, because the site was really built for me. It's on the site. You're going to get we just did a quick blurb on the durable goods this morning. We're going to keep you up to date on, I write a daily column called Daily State of the Markets, and I'm really identifying the drivers of the market. So if you want to stay in tune with what the market actually is doing, then the State of the Markets is going to help you out with that. That's kind of my overall theme, is that you have to stay in tune with what the market is doing. Check your ego at the door. Forget about the crystal ball. Focus on what is happening in the market, not what you think is or should be happening. So that's really what it's all about. We've our biggest program that people find most interesting is called the Daily Decision. This is we don't trade every day. We simply make a decision once a day. Should we be in the market? Should we be out of the market? Or should we be short? Currently, we are long. We've been long for a couple, last 10 days or so. Caught this rally kind of nicely. We also offer something called the Insider's Portfolio, which is pretty nifty. We're going to do a webinar on that on Tuesday on MarketFi. Introduce the idea of active alpha and adding alpha to your stock picking strategies. When it kind of makes sense when corporate insiders. When their stock has been going down, things are not looking so good on a chart basis. And then you see that corporate insiders are buying their stock and buying it heavily. There's a decent chance they might know what's going on there. So we run a portfolio like that that's been pretty good, been a lot of fun, and something that might be interesting for people to take a look at.